we're going to move immediately into that panel discussion. And I just want to remind the audience out there that please post your questions. We've got a lot of questions for you already for our panelists, but please post those questions. So first of all, I'd just like to bring back Dawie, Nikki, Estienne, and then of course for the first time, we've got Erwin Rode. So, and just a little bit about Erwin, just on his background. He's the founder of national research property firm Rode & Associates, which he formed in 1987. It's one of the larger independent valuation firms in South Africa. And over the past 4 decades, he's done pioneering research on the South African property market. He's also a property economist. He's a consultant property valuer. He's also a publisher and editor-in-chief of portfolio of property research publications. Holds a BA and MBA from the University of Stellenbosch. And he's also a part-time lecturer at the University of Cape Town, including a fellow of the South African Institute of Valuers and an eminent fellow of the Royal Institute of Chartered Surveyors. So welcome, Erwin. We want to say stuff. Wonderful. So Erwin, I think you obviously listened to Nikki and Dawie, and you've heard Estienne. What are your views? What are your views on the economy? What are your views on the real estate market going forward? I mean, you've done a lot of reports, so maybe you just want to add or comment in terms of what Dawie, Nikki, and Estienne have shared with us.
Well, as for the first two economists, I fully agree with what they've been saying. I would like to confirm what Estienne was saying. He was not a friend of property. It's as simple as that. In the end, it's the economy stupid. You know, it's the economy that drives the property market. I keep on saying when people ask me what are the picks for property, I say just ask me what are the prospects for the economy. And I must say, looking at the structural problems facing this country, I fully agree with what Dawie has been saying, and Nick. I tend to be even more pessimistic, looking very long into the future, because I compare South Africa to an island in the middle of nowhere in the Indian Ocean, and then somebody left a few cats on the island, and within a few years the cats destroyed all the birds on the island. And now what happens now? The cats start fighting amongst themselves. And that's what happens when an economy goes through a long period of underperformance, and unemployment grows and goes completely out of control, as we saw with the bank in Germany. Nikki, I hope you are listening to me. Yeah, so the worst comes to the fore with humans when under pressure. It's all very well and easy to be democratic and liberal and so good, and as long as you have bread on the table and even more. The problem starts when more and more people become unemployed, and then of course you've got to look for a scapegoat. And in Germany, you know, this was the Jews, which was completely crazy, because in America the Jews are they are the best performing ethnic group, if you can call it ethnic group. They to Nobel Prizes, to invest, to companies, far exceeds the average in America. Yeah, let's not hope that it comes in South Africa that we start looking for an scapegoat.
Okay, so I mean, Erwin, I know you're known for your pessimistic views, but also for your realistic views. And so, you know, the data tells a telling story. So, you know, that sort of becomes, you know, the reality. So what I'm going to do now is we're going to open up the debate now a little bit, and there's a lot of questions. So please, audience, send through your questions. We've got time to get through them all, because the networking is going to happen at part 2 of the session. And so first of all, There's a question for you. Yeah, how is the government, or how do they propose to pay for the stimulus package that you were talking about? Do you want to maybe give some ideas? I know it's a very difficult one. You're not in the government, but I mean, where would it be possible? I mean, there's no more money. There's debt. So
it's very easy to know where it comes from. I just want to make a comment. And Erwin has been saying a couple of things, and he says he's actually even more pessimistic than myself and then Nikki and myself. No, I think that's the first time I've met a fellow economist that reckons he's more negative on the future of South Africa. And I don't think it's being negative or pessimistic. It's about a matter of being realistic on where we are and the trajectory is going to follow. So the question is, where's the money going to come from? And the answer to that is pretty easy. And maybe I can just make another side comment, which will form part of my answer, and that is Nikki's comment about inflation, which she reckons is not a problem in the short term, and I absolutely agree with that. But, and this is the big but, it's my answer to where the money is going to come from. Now, when you get a populist, destructive, incompetent government like what we have in South Africa, the pattern is pretty much the same. Unlike what Tolstoy said that all happy families are happy in the same way, but unhappy families are unhappy in different ways. That's unlike with economies. Unhappy economies are pretty much all unhappy in a manner. Here's more or less the way in which unhappy economies are unhappy. First of all, you get a governments that start misusing the taxpayer until you run out of taxpayers because they need money to spend all these lavish ideas, and of course to for some other grand fancy cars, and I see really can go for fancy cars if they want to. But so first of all, you need money, and you go for the easy one, and that's the taxpayer. Once you run out of taxpayers, and we've run out of taxpayers, I can assure you, there's going to be tax inches here and there, but taxpayers cannot carry this burden anymore. So the second thing that you do is that you start consuming your existing capital. The existing capital has been consumed to a large extent. I think Eskom is an excellent example, where you simply just eat up your capital until there's no more much capital left to consume. Of course, there's more capital to consume in South Africa, but we've pretty much used that already. So there is not that option is not available, or that much available anymore. The third option from there on is that you have to find somebody somewhere, because you've got that huge patronage that you need to keep on feeding, and you've got this ideology that believes in getting as many people as possible dependent on the state. So your third port of call is to go to where the only pot of money is left, and that's the savers. And for that reason, I'm very concerned about prescribed assets, because I believe unless we really cut back on state spending, and quite dramatically, there simply isn't money available except for the pot of existing savings, and that is the savings industry, and that means prescribed assets for the pension funds. And it is going to be a gradual process, because there's so much opposition to this. It's going to be a gradual process. Say, for example, there's about 80 billion worth of Eskom debt at employment pension fund, convert that to equity. So that is nothing but stealing money from the government employment pension fund. So that's the third option, making use of the existing savings, or the only remaining pot of gold, that's existing savings, until you run out of that. And now you're getting into some real difficulty here, because there's nothing else that you can raid or steal. And so what do you do now? By then, levels have reached such high levels that the debt burden becomes unbearable, and interest on state debt becomes unbearable. And that, I've given you some of the numbers. Nikki will confirm this. So what do you do? Well, and the easiest option under these circumstances is to put pressure on your central bank to let inflation loose. Let me give you one number. After the Second World War, the British debt levels were more or less away. So they had very, very high debt levels. And 60% of British war debt was repaid through inflation. And that is my suspicion. This thing is it's not a matter of where you're going to get the money from. And inflation is nothing but stealing from the savers also. So that's where I think where the money is going to get from. And once you've got very high levels of inflation, that destroys your economy, and then all sort of bad things start happening. So I guess that is more or less the pattern. We're not, but unless we cut state spending, and like quite dramatically, and get good, competent government in place.
Great stuff. Thanks very much, Dawie. Okay, so Nikki, next question is for you. How much of the retail spending that you were referring to is credit spending, as in credit sales rather than cash sales? And I know this Estienne is obviously in the retail market. I don't know too much about that, about his tenants, but as in credit sales rather than cash sales, and what would the impact be of that in the future? How do you foresee that? So we're talking about debt on top of debt by the sound of things.
Yeah. From our perspective, that's actually not happened in this cycle. I think consumers have been, listen, we have to restructure, I think it's about 30% of our retail book. So that absolutely happened. There's no denying that. So clients that experienced either that they were running businesses where no income was coming in and they still had all the expenses, or they were running a small business, where basically their profit was their income, and that business, was a panel beater or whatever the case may be, and they couldn't operate. And then also a lot of individuals that were placed on unpaid leave. They weren't officially retrenched, but because the business had to close and the business didn't have the kind of buffers that big corporates have, they found themselves in a situation where they could no longer pay their staff, and they put them on unpaid leave. And so we had to restructure a lot of our retail accounts. As I said, it's almost, our total book was 30%, retail is probably about 20% of that. So that occurred. But when debt's being restructured, you obviously don't extend further credit. So that's the one thing to bear in mind. So in reality, credit growth has slowed. It's not. So the retail sales recovery you're seeing isn't actually debt driven. It's not dramatic rise in indebtedness at all. The opposite has happened. There's been much slower growth in debt. So there's still been growth, but it's been much slower, and it's continued to slow until very recently. The main reason indebtedness increased is because, remember, your debt stays the same, right? So unless you've paid it off, it stays the same. And so even though the new debt has been growing slower and slower and slower, income fell through the floor. So if you take that ratio, income fell that much faster than the slowdown in household debt, and therefore indebtedness rose. Now, clearly that is, almost like a technical factor that will to some extent, but not entirely, reverse in the months ahead. What we're more concerned of is that we will only really know what's going on with consumers and in the second half of the year. Because, as you know, some of the support offered by government has now been extended for another 3 months. All right. So then, once that support falls away, and companies reassess the entire economic environment, the entire macro that their plans and their budgets have been based on, and if that is adjusted downwards to a much weaker economy, to an absolute lower level, many will probably make the conclusion, all right, we carried people through this difficult period on the assumption that it would be a temporary disruption to economic activity. But if it's going to result in a structurally smaller economy, then we will also have to cut our costs. And that's, I think, sometime towards the end of this year, early next year, when companies will make a permanent, more significant decision on how large, and strategic decisions on how large they want their workforce to be. And that, I think, is when banks will face quite considerable amount of tail risk. And so that's our anticipation, is we're only going to really be able to assess the state of the consumer sometime later this year or early part of next year.
Great, thanks for that, Nikki. Estienne, there's a question for you. What are your views on both the current and medium term, that's 18 to 36 months, on valuation capitalization rates, given that the current forecast interest rate environment and softening rental outlook?
Actually, ask Erwin that question rather. He's must.
Well, what we can do is we can bring him in afterwards. We give your
the
view
valuation
first.
takers on this thing, eh? I mean,
Well, they
it comes back to
specifically
our
asked for
comment
you,
around that.
Estienne.
Yeah, I think it comes back to that investment market. I mean, valuations in theory should be a reflection of what a willing buyer and willing seller is prepared to pay for a specific asset, given the market and all the other dynamics taken into account. Now, we know, and Erwin will explain, that it's not a perfect science given the illiquidity market. So it's not an easy question to answer. But I would suggest that to the extent that rental levels remain under pressure, that we should see a further weakening in valuation still, as we have indicated earlier, and the only thing that will probably help is if this interest rate environment continues to drop off, because then, as I mentioned, there will be assets with a very long growing income return. And if you are an institutional investor, that kind of investment is worth a lot of money to you in this environment. So you might find that there could be a couple of big assets moving that have got sort of really good quality leases, and the reason is that the institutional investors do need those yield investments. So it's not an easy question to answer, but I can tell you one thing: on the smaller side, on the weaker side, I think that valuations there, certainly our experience is we are doing active trades in some of these smaller assets, and in fact there is quite a reasonably liquid market in the very small assets. People buying those investments for their own businesses, owner operators, and that market seems to be still reasonably liquid. But as soon as you start getting into the bigger assets, that's where liquidity dries up pretty quickly.
I found this latter comment by Estienne very, very interesting. Saying is that your very big shopping centers or your very big office buildings, etc., that they are less liquid. In other words, less trading is taking place, which makes it very difficult for valuers to estimate things like capitalization rates, of course. So therefore, what I'm going to do is I'm going to tell you what the fundamental drivers of capitalization rates are. It's very simple, actually, if you come to think of it. The first important driver is prospective growth in the economy. In other words, what is the prospective growth in rentals going to be? When that prospective growth is high, people are optimistic, then all other things being equal, buyers are prepared to pay more for the same first year's net rental income. And that's logical, not so. I mean, shares also work on that principle. The second driver is the substitution principle, and this is the long bonds. Long bond rates are also a driver because it's a substitution for investing in property. And we know that long bonds have been rising, as we saw this morning, and maybe we could get the opinion of one of our economists on what future of long bond rates are. My common sense tell me that they are going to rise. It's inevitable when you are going into a fiscal trap like we are. So both the important drivers of capitalization rates are, in other words, showing that cap rates must rise. That's now, of course, ignoring the listed sector. The listed sector has been foreseeing this for a long time, as we see, as we've seen in the prices tumbling over the past 2 years or so. And it looks like the directly held property is going to follow suit. The problem with directly held property is that your valuers out there are very slow to recognize what's been happening around them. They are very conservative, and on top of that, I'm afraid I've got to make this point that there's always pressure, not always, but there's often pressure from your client to how shall I put it, to support values, if you know what I mean. So yes, that's about it. Rental prospects are poor, and so are long-term interest rates. And I would like the two economists maybe to comment on that, whether they agree that the prospects for long interest rates are poor or not.
On long rates, I can certainly say that. Yeah, I mean, listen, we've got a very steep yield curve, like I pointed out. And the easing of monetary policy to a large extent exacerbated that situation, because it basically dragged the curve at the bottom, at the short end down quite sharply, where at the longer end of the yield curve, what's being priced in is all South Africa's macroeconomic structural risk, but specifically our fiscal risk. So if we look at the fiscal situation, you know, there are a lot of people, I was at the IMF meetings yesterday, which consider South Africa's risk of default, that's now be the sovereign's risk of default, as a medium risk. They think it is a risk. And that's what's being priced in at the longer end. And I don't think that's going to change until you put in place and start to show that you can deliver on that, a realistic fiscal path towards reducing the deficit and towards containing debt. And unfortunately, I still don't think that is in government's thinking. It's almost like they feel they have to lead economic recovery. And I think Dawie made the point. You've got a certain amount of money. We know there's a tremendous amount of wastage in it. To spend it better and spend it more effectively, and measure your outcomes and award those, you know, link pay and performance. And those that don't perform, you know, don't deserve to get a sort of standardized increase across the board. So I think that there's all of these sorts of changes that can occur in the service that could potentially reduce our risk. But right now it's heightened. That's really what the sovereign rating reflects. It's all being priced in on the longer end. So it's going to be quite difficult to permanently drive your 10-year bond yields below 9%. I think it will be quite difficult unless the fiscal metrics improve substantially. You know, unless they can manage to bring the budget deficit from around 16% this year down to 10, down to 9, down to 8, and they start to deliver on that. But with deficits that high, I'm afraid you're pricing in that risk at the longer end, and it will be there.
Yes, maybe I've got a slightly different take on that one. Let me just explain my thinking behind that. Remember, the South African financial markets are very, very liquid. The South African currency is a very undervalued currency, and the South African bond yields are very attractive compared to other bonds in the world. Now, I can easily envisage a scenario where a foreign investor, well, not investor, a speculators probably, will look at South Africa and say, listen, I've got a cheap entrance, the weak currency. I've got a very liquid market and I've got very attractive yields. I want to come and take a quick bite out of the apple. So leading to a huge inflow, sudden inflow of capital into South Africa, take a bite out of the apple, and the moment something goes wrong, the money flees out again. But in that process, it's quite easy for me to think, of bond yields going down to 8-7% sort of thing. So that is don't underestimate short-term capital flows, especially it's driven like for example speculation. So under that kind of scenario, it's quite possible. The second point that I want to make is that I will be very surprised if the African state or the government defaults on their rand-denominated debt. Because for all sort of reasons, in the end, you can simply force the Reserve Bank to buy your debt. So I don't think that in itself is going to happen. It is possible on our foreign-denominated debt, but that is also not a simply because we have sufficient reserves and our foreign-denominated debt is quite low. The reason why the bond yields are high, relatively high, obviously for the reasons that you mentioned, but I also suspect that the bond yields are gradually starting to price in some inflationary pressures over time, which in a way it's a form of a default. I guess you can call it as a form of a default. So I'm not too, but there are some, my thinking, perhaps not that much.
One interesting thing I can with you, Dawie, is we're actually not seeing liquidity. There is very, very little liquidity in the bond market. And there's also, especially foreigners coming in. So yes, you're right. The bulk of our debt is rand denominated, so the central bank can just buy it, and that does reduce the risk of actual default. Exposes the foreign investor in rand denominated debt to a huge amount of currency risk, and obviously inflation risk. But the one interesting thing of this crisis, if you think of all the previous crises, it's always been the case that, and this is the COVID has been so very different. The rand would take a risk event, and after that, high interest rates relative to the rest of others, they all ease to near zero, and the capital will come flowing back. This time, it's trickling in, if at all. So volumes have remained incredibly thin. Liquidity has remained incredibly thin in the bond market and also in the rand market, and that's why the rand's movements are actually quite extreme. It can go to like 16 against the dollar in one day, and with one deal, it goes all the way up to 16.90 again. So we are not seeing the liquidity we anticipated would actually come. So, and I can tell you that from the international meetings, the international bankers we met with, it's a lot of negativity towards South Africa. And maybe you're right, maybe it's not so much, there really isn't a belief that government can implement fiscal consolidation. They just don't buy it. Okay, that's the one thing. So government will have to prove that they can do it. And secondly, there is just the sense that we do not and will not implement the kind of changes that will produce economic growth. So if you sit with such a big amount of building and mounting debt, yeah, you're right. You either inflate it out or you grow it away. And if we're not going to grow, then inflation is the last thing left. So you're probably right. It's being priced in on the long end. But we're not seeing that flow of liquidity. It's very thin on the ground. It's very disturbing, actually.
Yeah, I don't want to make a big thing of this. I just want, you're right. No disagreement there. But it's interesting that the Reserve Bank recently started participating in a bond market, which is, of course, they say it's simply to unblock liquidity. But that is a first tiny step for the central bank.
In the wrong direction, yeah.
Yeah.
For sure.
Anyway, well, for now, they're okay. Yeah, but no disagreement.
Okay, so let's just move on. And I think we're going to come back because there's a lot of questions related to economy, which I think is important and critical, because I think people are also trying to say, well, what is the new solution? How can we, what is the answer? Now, first of all, these two questions, and I'm going to come back to you, Estienne, and you to Erwin and bring you in. There's one that came from an anonymous attendee. First, there was a comment, and I'd just like to also comment on the general comment from Robert, who said, why is the panel so white? Well, Robert, let me tell you what, it's always a challenge for us to get the right people in the industry on this particular one. I know Dawie wants to chat about, but it really is. It's a challenge getting the right people in terms of this particular panel sometimes. And, so in our future ones, we do have, good representation. Sorry, Dawie, did you want to comment on that?
Yeah, yes. Let me just help you out on that one. So don't worry about that. I had my genome analyzed, and I can assure can assure you that I am from a variety of ethnic backgrounds, and in fact, I am from a variety of species. In fact, I'm a hybrid, and I've got proof that I've got genetic proof for that. So don't worry, the panel is pretty much represented.
I don't know if anybody else wants to comment on that one, but I mean, it is a challenge in terms of getting all the right people into one room at one particular time on a particular subject. So Dawie, there's a question for you. It says, please explain in more baby steps, and we spoke about inflation, how inflation will pay debts. Can you maybe just elaborate a little bit on that, or will it?
Yeah, it's easy to explain that. Remember, inflation is simply, there are many definitions for inflation. Let's just look at the two definitions. The one definition that we all know is the continuous increase in prices. Things get more expensive in simple terms. That's one definition. The other definition for inflation is money keeps on losing its value, or the continuous fall in the value of money. Now, I prefer that definition because the increase in oil price, as an example, is not inflation. It's only when the price level, general price level increases, then only is it inflation. Or you can look at it differently. So money loses value, that is inflation. So it's two different definitions, but it's two sides of the same coin. But debt is also money. Debt presents money. So if you have inflation erodes the value of money, and it erodes the value of debt. That's simply how inflation repays your debt. And I've done some calculations, and I can tell you, so what adds to debt in South Africa? Remember, debt is reported in nominal debt. So we owe currently, Nikki, how much is that? We owe about 2 trillion rand worth of debt. And imagine an inflation rate of 10%, and then roughly speaking, in 1 year's time, that 2 trillion rands worth of debt will be eroded by 200 billion rands worth of real money value, if you like. So that's how you use inflation to erode your debt. And that's an old trick used by politicians. If you don't want to cut back on state spending, you let inflation run amok. Your nominal economy, in terms of the size of the economy measured in terms of normal rands, will look bigger, but your debt is captured or fixed in yesterday's nominal value. So relative to the size of your economy, your debt comes down. I hope that makes sense.
I think great way to explain it there, Dawie. I want to bring in our two property guys, Estienne and of course Erwin here. What is the new view on prime hurdle rate targets for, say, a new 10-year prime industrial investment? Sector differentiator thereafter will into, say, prime retail. Do you want to comment on that, Estienne?
So look, I mean, reference point will always be to our cost of capital, on a weighted basis. So obviously what increment it would cost, what the forward yield, if you actually know what it is on your share is, and that combination will sort of give you an indication of what your weighted cost of capital more or less is. And based on that, that would provide the sort of base hurdle on these investments. Now, historically, the sort of total returns we've been looking for out of industrial has ranged, depending on the government, and it's a broad range of 15 to 20% would have been a total return sort of expectation in that specific space, right? And in this environment, given what's happened to the share prices and certainly what Erwin's comments were earlier, which I do agree with, I don't foresee that those total return demands are going to be coming down materially. And on top of that, if you've got a very increasingly shorter life cycle on your asset, those aspects are also relevant.
Good. Erwin, do you want to add to that?
Yes. Look, the way valuers look at it, of course, is that the simple calculation is that you start off with your capitalization, say 10% for argument's sake. A year ago, that would have been, say, 9%, but now it's 10%, say, depending on the type of property and the location. And then here comes in the tricky part. There are still valuers out there who think that rentals or net rentals, net income, is going to grow at 5-6% per annum in perpetuity. I am of the opinion that going to get on top of the 10%, say 2% growth in your net rentals in perpetuity, then you're doing very well, because that is then, say, 11-12% compared to an inflation rate of, say, 3% or 4%. That is, in my book, an excellent return. Now, I don't know how long it's going to take for valuers in general to bring down the expected growth in perpetuity of the cash flow, but let basically is at home over the next year, then on average, maybe valuers will bring down the expected perpetuity to say 2% or 1% even, on severity and depending on your long-term outlook prognosis for the economy. So yes, I would argue that in today, if you can get a 12% or 11% or even 10% return. Remember, this is property. Its risk is supposedly much lower than equity listed on there. Compared to an inflation of 4%, then you're doing pretty well, because in the long run, international experience tells us in the long run, when a landlord has so-called naive buy and hold strategy, the way that our institutions used to do it until about 1994, then the long-term return you can expect is about 4% real return per annum. Now, it's inflation plus, say, 4%. So if you're going to get 4% plus 6% or 7%, then you're doing exceedingly well. The other important point I would like to make is that one tends to think short-term. It's natural for us all to think short-term. The problem with property is it's a long-term investment. It's got a long cycle, 15 to 20 years. So you may have 10 years behind you of rentals growing in real terms negatively. And everybody gets annoyed with property as an asset class, and then they jump out just when property cycle, the long cycle, is at its nadir. And this is how I got the badge that I'm a negative or pessimistic property economist, because I've been saying for the past 10 years, guys, we are in a real downturn. You can see it in office rentals. In real terms, office rentals in South Africa have been coming down for about 10 years or so. And industrial properties too, in real terms. But the offices, its cycle is, this time around, the cycle is going to be longer than 20 years, it seems to me, given the special circumstances we are in right now. So now people think, the past 10 years was bad, therefore property is bad. Instead of thinking long term and thinking the property cycle. Now, if this were a normal business cycle that we are in here, then of course property would be a steal now. Given the high capitalization rates and given how low market rental rates are relative to replacement costs, right? Unfortunately, this is the big problem. I don't foresee this being a normal business cycle downturn. This is something much, much worse. Therefore, that has an influence on your forecast of market rental rates over time. The other important thing I would like to mention while we are on this topic is it's evident at the moment that it's not a good idea to hold B class and C class assets. Because what's been happening is that tenants move out of their B class to A class. Why? Because rentals are relatively cheap relative to replacement costs. So as a result, the vacancies in B and C class properties have become much, much worse than in the case of A. In the A, of course, the vacancies there are attributable to overzealous developments. developers who are not appearing into the future. Have I answered the question?
Yes, Anna, I think you've
One dynamic
elaborated.
that you'll see, though, Neale, is, if the properties become quite cheap, there's quite a few alternative uses. So you're already seeing, over the past kind of couple of years, I would say there's been quite a lot you've seen in Cape Town. You guys sitting there, how many empty office blocks have been converted to empty flats in Cape Town. So that's the one aspect that you'll see. But I think the uses are broadening. There's office buildings can become educational or student accommodation, or even increasingly the demand for aged care and healthcare is phenomenal, and property investors, different investment, ultimately might decide to take the step and convert, or sell those assets to those people at levels where those conversions make sense. So there is a bit of entrepreneurial activity. Be interesting to understand Erwin's view if you do see inflation, because there certainly is a view that probably is inevitable given what we're up to in the country at the moment, and that might have a bit of a dynamic over the medium term for real estate as well.
Neale, can I come in here on inflation? I'm very glad that Estienne gave me the gap there. There are two types of inflation. Every economist will tell you. There's the cost push, and then there's the demand pull. Now, cost push you get typically when the rand crashes, say. Imports become more expensive, and eventually it is passed on to the consumer. Now the consumer starts demanding higher wages. That's a cost push, one type of inflation you probably have today. We've got no demand push inflation. I think the economists on this panel will agree with me. Now, the interesting thing is, a study was done many moons ago by a Sanlam employee who was doing his MBA, and he did a mini thesis for his MBA on this aspect. And you know what his conclusion was? Oh, by the way, he was working on the total property portfolio of Sanlam at the time, which was going back the furthest of all property portfolios in this country. So he had a good database. And that database stitched over a period where we had both demand pull and cost push inflation. And his interesting conclusion is that cost push inflation is not good for property. It's the demand pull type of inflation that is good for property prices. I'm sorry, guys, that's the bad news.
Okay. Well, we've got to take the good along with the bad news. And I want to bring in Nikki here. It's actually a property-related question to you, Nikki, and I'm not quite sure it was sent for you, but it was related to your presentation, I think. And it says, looking at property prices in the Western Cape, and, Erwin, I also like you, if you want to comment on this as well. It seems as if low interest rates has increased the demand to residential property to such an extent the property prices has increased in certain areas. Is this not the case in the rest of South Africa, as the home price index is in a decline on the data of your presentation? Your comments on that? Nikki?
Sorry, I was on mute. When I look at it at that sort of extremely detailed level, but yes, it is not the case in the rest of the country. We know that the Western Cape has always been a bit of an exception to that rule. And, also you had that sort of migration from the north, if you like, Gauteng and other areas to the Western Cape that also fueled demand. It incredibly popular, a spot foreign purchases as well. So it's always been a bit of an exception of the rule, and we've seen it in our book as well, but that is certainly not the case elsewhere.
Okay, great. I don't know if you wanted to add to that, Erwin, just on, in terms of the Western Cape where you're based, or if you can add anything further to that?
Look, the stats produced by various sources definitely show that over the past, I don't know how many years, maybe 10 years or longer, the Cape has been doing better. I'll never forget. In my book, the change happened. The change happened best in 1983 after the gold boom, the last gold boom. When all of a sudden I discovered, to my surprise, at the time we had a Rode house price index, and I was one evening I was revising it, and I was looking at house prices in what we now call the bowl, the city bowl of Cape Town. And to my surprise, I found that there was a tremendous growth in house prices after 1985, in house prices in the city bowl of Cape Town, much more than away. And my theory at the time, and still is, that what happened was, with the gold boom or during the commodity booms that we have from time to time, then of course the economy of the Witwatersrand, for instance, would do much better compared to the Western Cape. And what happened by the mid-80s, of course, that advantage, competitive advantage of the Witwatersrand had changed for the negative, and the Western Cape's economy, which was small and is still more diversified, was doing relatively better. And so this is the explanation I came up with then. Of course, since then, as we know, the semi-migration thing that's been happening, and the semi-migration thing doesn't only affect the Cape, city of Cape Town, but also the South Cape. It's a very popular area for people who are coming to retire. However, having said all this, in the end, with the headwinds we are seeing at the moment in South Africa, it's also going to affect house prices in Cape Town. It's a question of time. We see house prices growing negatively already. We've been seeing it for a long time now, for about a year or two, three. And even we're all very surprised with a 1% growth in house prices after the lockdown. That is still below the inflation rate. So my premise that house prices will keep on declining in real terms for another few years then still holds. So if you buy a house or a residence with a view to capital appreciation, you're not going to get much over the next few years. That's my view. And in fact, when you are having a 90% bond on it, or even higher, then you're going to have a negative gearing effect. So from a purely investment point of view, there's no hurry to buy a house at the moment. That's my argument, and that goes for the whole of the country.
Wow.
Neale, just maybe a comment there, Neale. Anecdotally, some of the guys I've spoken to in the sort of residential development space, and this seems to be relevant to most of the coastal property areas, is they've had a boom time in the recent couple of months, and it's kind of disconnected to what's going on in the economy. So the only thing we can think is that maybe that the low interest rate environment and a lot of money floating around in PPE and other kind of spaces, as well as maybe a strong mining sector, might be driving that activity. But I don't know much about that resi space.
Yeah, no, it seems that there could be a backlog, obviously, at the deeds office. And so there's a combination. And I think the entry-level first-time home buyers market under $1 million is very much a low-hanging fruit at the moment. So I think it's a combination. I think Erwin might even want to comment, but I'm going to ask him to comment on that a little bit later because we are running out of time. So I'm going to go around to the panel and ask you each to give about a four-minute wrap-up. And Dawie, we're going to start off with you because so Dawie and guys, we want to leave somebody with positive. Can we leave something really positive? So Dawie, let's look at China. And China, probably in the early 60s, if we look at what was going on there, they had 45 million people starving. They were in deep poverty right about that time. And there was a question related specifically to hyperinflation, and we always get compared, I think, to Zimbabwe and Venezuela. I think it's almost like standard, and is South Africa going to go this way? And what are the likelihoods and risks of going into that hyperinflation environment? And a question around the if so and would you invest? But maybe let's get back to the China story. Let's say, what do we need to do? Maybe give us a way forward. You are the Minister of Finance, you are the President of the country, you're an economist, I know, but give us a way forward of what must be done.
It's not good enough. You've got to make me a dictator. Let me just make a few comments. One is that I'm very sorry, Erwin, but I have to disagree a little bit with you about your distinction about so-called demand and supply, push and pull inflation. Inflation is inflation, and that's it. It means money loses its value, and that's why I prefer the definition, the second definition. There could be sort of various different sparks or stimuli that gets the process going of inflation, but essentially inflation means money loses its value. And if you make a distinction between supply and demand, reasons for inflation, essentially what you're trying, you're looking at other factors in the economy. So I just want to make that general comment. I'm a bit of a very conservative as far as inflation money is concerned. I'm really all right. The inflation, the China story, and let me answer the China story slightly different, perhaps. This is perhaps my positive note that I would like to end on. If you stand back for a moment, and see how economies typically evolve over time. Now, if you really want to understand what is going on in an economy, your best person to go and talk to is an economics historian. They understand economics better than anybody else because it's the same story all over again, but things are changing. This time around, it is different, but in a way, it's still the same. Now, the different parties, and I think that is actually the really good news story, is that if you stand back for a moment, you will see that economies typically start off in the primary sectors, that's agriculture and mining. And then that's where most of Africa is primary, but basically there still. And then you go into the secondary sectors, and that is where the Chinese are. They the factory of the world. The Japanese used to be there. The Chinese are there at the moment, and some other countries are there, like for example the South Koreans. They are there. North Korea is in a pre-primary stage, I guess. And then from there on, economies evolve, and this is where China is gradually moving to, is into the tertiary sectors. And the tertiary sectors are what we are doing at the moment. And the tertiary sectors are other things. Let's call it the internet economy, or you can call it the fourth industrial revolution, or you can call it the gig economy. But that's the part of the economy where services are rendered, like Google, like news services, like internet stuff. All that is part of the information economy. And the characteristics of the information economy is that it is service orientated, and it's something that can be digitized typically. So that's where economies are growing today. Now look at our economic plan that the president introduced now. He says we're going to get people to clean the parks, and we're going to get people to help the teachers, and we're going to start all these public works and so on. That's primary stuff. That's not long-term real economic growth. And that in a way is not a good news for those people because they can't participate in the industrial revolution, modern economy. They don't have the skills because of the quality of our education system in South Africa. But many people can actually participate, and I say it's people on this platform mostly, on this forum today mostly. We have got the skills to work Zoom. I'm still figuring out how it works, everything, but I more or less I can get going on Zoom. The services that we are provide are services, and much of that can be digitized. An example: I was in New York last year, and I had a meeting with my team, and they didn't even know that I was in New York. And that's the good news. It means that you can be part of the fourth industrial revolution of the modern economy, of the tertiary economy, where economies are growing, and it doesn't matter where you are. So we are at a place where, well, Donald Trump has certain words for it, but we are at not a very pretty place. And that means that you have to understand that. You have to make sure that you're physically safe. And that's about it. And you need skills and you need a connection. Then you can participate. It doesn't matter where you are. And that's the good news story. And I can really go on. I can even add things like, for example, so-called cryptocurrencies. I prefer the private currencies. And eventually, we can actually start a completely and totally private monetary sector or payment systems and stuff like that. So, to steal a word from my good friend Pete LaRue, and he created this word to create a state-proof business. Technology will allow us today to create state-proof businesses. We don't need the politicians. So don't worry about the mess they're making. As long as you've got the skills, as long as you're personally and safe, and as long as you've got the connection, you're up and running, you can be part of the modern economy.
It's a wonderful way to end. Dawie Roodt is the founder of the Efficient Group. Dawie, thank you very much for your input today. We're going to go around to the rest of the panel. If I could ask Nikki, could you give your wrap up, please, and your final parting shots and your thoughts on a way forward? Your thoughts, please, Nikki.
Yeah, it's a difficult one. I think we've been in a tough spell for a long period, and this particular crisis has just added to that, to the challenges we are facing. I think as far as government is concerned, there's a lot of criticism about the economic plan. But that it was discussed with business. It does contain some positive elements. If we can just see some implementation, and if we can see some of that low-hanging fruit that's been dangling out there forever being picked, it will create opportunities. It will very slowly lift confidence. And we will have a recovery. It may not be as robust and as convincing as it could be if we were willing to make the more difficult changes, but we are in the midst of a recovery, and I think that is the positive out there. And at least for most part, this new plan has got some really good elements that could greatly improve the investment environment if they are actually implemented. And that's where I'll leave it. It's all about implementation now.
Wonderful, and I think a very nice way to end. Thank you, Nikki Weimar, the Chief Economist of Nedbank. Thank you for joining us today. Great insight there on the future of the economy. So not all good news, but bad news, but some sage advice at the end, which is great. Okay, Erwin, I'm going to ask you to give your wrap up and your thoughts going forward, and What are your thoughts around this?
Well, I would like to make points. The first one is that one mustn't confuse the listed sector with the directly held sector. There is some connection, of course, but the listed sector, as we know, is more volatile than the directly held sector. Unfortunately, because the listed sector at the moment is punished by investors, it also means that they've got less liquidity or less urgency to buy directly held property, and that, of course, eventually is another factor that is going to and is already pushing up the cap rates of especially your institutional quality properties. I can't remember what my second point was going to be, but I think that is enough to wrap it up from my point of view. Okay,
you don't want to give a final word that you can just a little bit of positivity that we can take out, maybe something that somebody could use and say, right, I think what Erwin has said, that's a great point that I could use going forward.
Look, the positive thing that, say, Nikki has said, and what Dawie has said, the movement towards the tertiary sector of the economy. I mean, that's a very old trend. It goes back 40 years or so. The problem for a country like South Africa is, of course, unfortunately, I've got to point it out, is that it leaves 80% of our population out of the loop. That, I'm afraid, is well, I hope you won't mind me saying so, but I'm just a messenger. I know you want something positive from me. Yeah, the positive thing that I was going to say is that property is just one investment class. And if we are going to expect, as we are expecting lower total returns from property in general, then the question then is, what is the alternative? I think it was John Foster who said, considering the alternative. Well, many of the alternative asset classes are also in the same space, of course. So it becomes more and more difficult for the Dawie Roodts of this place to invest for his clients, unless you start thinking of overseas investments, which in itself is also problematic because assets there are also skewed through the very, very low interest rates. So the positive about property is that if you are buying something at a 10% initial yield, and you are reasonably confident that you are not going to have negative cash flow growth thereafter, then the 10% yield is quite a decent yield in the current circumstances, giving you a real return of, say, 6% or so, which is quite decent. In fact, it's better than average. So, so the big question then is, as an investor, ask yourself, when you buy a 10% yield, what are the prospects for this type of property in this location? Are we going to have negative reversions and things like that, of course? I hope there aren't any people left who buy properties on based on the escalated rentals of yesteryear, in the hope that they're not going to have negative reversions in future. So that, of course, is a trap for many an amateur investor.
Sure, that's a wise word. And on that note, thank you very much, Erwin Rode, who's the founder of Rode & Associates. I know there's a few comments with regards to logistics and student housing, but I think we're going to discuss that in our next session, which is part 2. It's 2 weeks' time. It's actually going to be on the 3rd of November. And we're actually going to go into logistics quite deeply, and also into student housing, which we're discussing, in fact, in our last section. So so please look out for that, Rian. You can get it out then. But I'm going to ask Estienne. So Estienne, the reason I've asked you to end off, because you got the last word. You can leave the lasting thoughts with everybody out there. Now, I mean, you are the CEO of the biggest REIT, and you guys have had the rug pulled out of you when lockdown came about. I mean, it was unbelievable. But you mentioned a lot of things, throughout your discussion and your presentation earlier, being entrepreneurial and just, looking for the opportunities. So I think maybe just leave us all with your final sort of take and on a way forward, where you place and what people could probably take forward positively. And I use the word positively.
Look, I mean, you have to be realistic, but I think the one thing that is evident is South Africans have always been quite resilient. And generally, we've got very smart people in this country with a lot of skill. And there's, when somebody's selling, there's always somebody buying, and they're buying with a different view. And that's what creates a market. And in this environment, one guy is selling at one yield and another guy's buying at another yield, and they might not be the same yield, albeit that it's the same price. So I do believe that, for investors looking, and I mean, specifically into the listed market, which is obviously probably the cheapest, most liquid and tradable way to get exposure to real estate. And it's also where the most inefficiencies lie and the biggest opportunities lie, in my opinion, certainly in the short term. I think that there are companies that are being mispriced. I think that they have diversified income streams that aren't all South African, and they're being valued by the market as if they are purely South African. Now, the reality is each one of those markets have different dynamics, and those income streams, should be maybe valued slightly differently. Over and above that, I do think that as I mentioned, the operational management of these assets do provide opportunities. Often they have different uses, and not all of it is negative, and some of it will be has long enough leases in place to maybe see some through the cycle. I do agree with Erwin that in the short term, I do think that there are certainly the bottom end of the market's going to be pretty tough, but that's where the traders and the entrepreneurs are going to be feasting and buying assets to convert it to whatever else, and where there is a demand for something, there will be a businessman or a developer that will provide a solution. And I think those are, certainly there are certain niche areas in the market that will see opportunity, where the government needs money. And I know the word privatization is like a lightning strike from hell, but there is no doubt in my mind, if I go and look at some of the developed economies around the world, they have privatized their harbors, they have privatized their rail, they have privatized their utilities. And in my mind, in itself, that will be a good investment growth opportunity going forward, across the markets. So I think, it's not a rosy picture, and I don't think we're naive, but there's no doubt that there are opportunities to make money. And if everybody's thinking the same, then somebody's not thinking. So the reality is some of us have to kind of look out and kick the tires for those opportunities.
I think a wonderful way to end. Estienne de Klerk, CEO of Growth Point Properties. Thank you for that. I think that was a wonderful way to end. And once again, I'd like to thank our panel, Dawie Roodt, the founder of the Efficient Group, Nikki Weimar, Chief Economist at Nedbank, and of course, Erwin Rode, the founder of Rode & Associates. Thank you very much. Just to let you know, for the networking, we're going to send you the attendee list. And if you want to select people that you'd like to make contact with, please let us know. We can set up the appointment chats with you. The plan is that we do breakaway groups in our part 2 session. And that's what I want to remind you about is the banner should go up now for our second part 2 of the virtual property conference brought to you by Real Estate Investor and Rode will be on Tuesday, the 3rd of November at 10. And it's the state of the commercial property market, retail, industrial, and office sectors. And even though Estienne he's a specialist in all 3 over there, we do have other guests on that particular event. And if you haven't booked yet, just click on the link below and you can go along on that. And then I want to remind you, of course, about Tuesday, the 17th of November, where we talk about the state and the prospects of the residential property market. So please join us for that. And if you haven't booked for that, make sure you do that. And then this Tuesday, we have a free gift. We're giving you a free webinar for those of you on this particular webinar. And we're talking about reimagining the commercial brokerage, where there's a lot of innovation that's happening in that sector. And we're going to have a great discussion about that. It's a free webinar. It's going to be this time, 11 o'clock to 12:30 next Tuesday. We look forward to seeing you there. And other than to thank all our panelists, thank you all once again. I think you were fantastic. Petersen of Real Estate Investor signing out. Thank you all, and stay safe and safe investing. All the best. Goodbye, everybody.